Good evening. Welcome to Legends of Water, which is Thursday, June 19th. Juneteenth, for those of you who keep track. The main thing about that was that the stock market wasn't trading today, which had us all in suspense. One heck of a stock market. And one of the very interesting things is what is going on with infrastructure. We hear a lot about energy, we hear a lot about so many things, but water is emerging, and that we'll be talking about further. So we were doing weekly briefings before, so that's why we're up to 275, but this is the 12th episode, 1 year of our monthly Legends of Water. And as always, we have a VIP guest, and you'll be very amazed and pleased by the information that'll come this time. Okay, safe harbor statement as usual, the Regulation D accredited investor offering, and in fact, Regulation A just launched, and which means that all investors can participate. Now, what's cool is that basically there's almost a $1 trillion demand in construction-ready water infrastructure projects. Literally, you can look them up on a map. That's how crazy it is. Well, this enables anyone to invest. And now, if you go to waterondemand.net and click invest, this is what you see, and you get to go take a look. So that's a great step. And thank you, AJ and team, for making this happen. All right. Next up. We're going to do a quick recap of what Ken gave us last week. So just to bring us up to speed, some of you were there, but I think it's worth a quick cut. So let's roll it. Welcome, everyone. We'll get started now.
We now have a public-facing offering allowing even new investors to participate inside the OZ fund, kind of in the GP space.
General partner.
Yeah, general partner. So the way I've kind of approached this with the general public is it's kind of a unique chance for the first time for folks to own the fund and own a piece of the company that I think, if I can prove my case, we can connect a really significant chunk of the $1 trillion of capital that's currently actively seeking a home to the $1 trillion of stalled unfunded water projects. Now, there's lots of opportunities that folks have. A lot of them don't really have the opportunity to do this. You're entering early before the tax advantage money flows in on the LP side, which is very unusual. You own a piece of the world's first water infrastructure fund exclusively for private investment. You'll also own a company that owns the assets and owns the contracts. I think we create a brand new, vibrant, uncrowded asset class. The need for water infrastructure now, it's always been intense. We've been saying it for decades, but it's actually much, much higher now than it has been in recent years. Amazon simply takes your order and delivers goods to you from a seller, okay? We want to position ourselves at the center in between investors on one side, seeking tax advantage, safety, and income, and the manufacturers and projects that desperately need financing to make America go, right? There's $1 trillion of construction-ready infrastructure jobs. They're stalled, and they're not going to be restarted because the funding isn't there. It just so happens there's well over $1 trillion of capital gains. Now, the clock is ticking. They have a 180-day window to find a home in order to not lose their tax advantage. So it's kind of a perfect match. So the market that's already in place, these unfunded projects, these are already signed deals. These are things that are ready to break dirt, ready to break ground on. The amount of water and water usage is going to be truly mind-boggling. Every bit of this manufacturing that we're describing all requires massive amounts of water. Okay, so it really is setting the pace for, or setting the stage for, probably the largest need for funding in recent American history. Before you can finance equipment, you got to make sure there's the capacity to build the equipment. So we have multiple operating divisions with whom you're very familiar. They couldn't scratch the surface, but the capacity to manufacture all of this water equipment has already been there. There's tens of thousands of competitors of PWT and MWS that operating, simultaneously. They have the combined technical brilliance and capacity to meet the need. So we want to be able to finance it all. Because we're decentralizing the capacity to basically fund everybody, thousands of companies, as demand grows, they simply hire more people. And of course, this creates a tremendous economic boom. We could never build an asset class because tax advantage money needed a tax advantage in order to send you 200, 300, 400 million dollars. So the trillion dollars that's out there, it was never going to find its way to water. By putting this inside an Opportunity Zone fund, and you basically build the finance and you build a long-term operation and maintenance contract, Water on Demand will now basically put assets out there, will fund the project, and will own the asset and will own the contract. So it'll be a highly secured asset. That's where Water on Demand has finally placed itself. This is a superior instrument to other assets that are currently in the market. 99% of all of the money is in right now in OZs. It's in Opportunity Zone properties, OZPs. That's basically real estate centered. They have to be operating inside the OZ funds. OZ companies, brand new. And it's a really different world. What we're able to do is build these things and put them out anywhere in the world. We're not limited by physical proximity to an OZ zone. We're operating in the OZ zone. And we're going to be competing with other asset classes. How do we compare? We're about 15.1% unleveraged. On a leveraged basis, we're about 20, just a little over 20%. Highly competitive when you compare it to real estate at 5 or 8%. Solar at 10 to 15, and oil and gas anywhere from 5 to 12%. Let me spend a minute with you on how it all works, right? So these zones have been around since 2018. It's been almost an exclusive destination for capital gains money that goes into real estate. So under normal circumstances, there's only one way to invest in an Opportunity Zone. I have a capital gain. I sold a business. I got $1 million cap gain. I go into the fund. The clock stops ticking on my capital gain, right? I enter as a limited partner. I split the profit shares. The general partner or the owner of the assets gets the depreciation, but I get all of the income, and I get it in a tax-free environment. That is generally how it works. 20% of the income goes to the general partner. 80% income goes to the limited partner. We've done something a little bit different. We've opened up the general partnership, at least on the first fund only, to the general public. We can now build a massive asset base. So when we do exit for a liquidity event, we can do so as a much more mature, much more asset-rich company, okay? How do we do that? We own the assets, we own the contracts inside the Opportunity Zone. Now, because it's financing, it ends up allowing to leverage investor dollars. Remember, we intend to borrow some money and use debt to increase return. So, on a $100 million fund, you may even control $120, $150 million worth of equipment, which would give even better returns, right? So now, why are we giving up the 20%? Well, we intend to have 20%. We intend to own the sponsorship of each of the subsequent funds. And as I said, it's such a large space, you couldn't have enough of them. What is a company worth that owns the paper, if you will, on $10 billion worth of infrastructure equipment financing? How much is a company making if it also owns the operations and maintenance contracts on those tens of billions of dollars, right? Lastly, how much is the company making if they're receiving 2% on every dollar that's being managed in that fund, right? Because at the end of the day, we're almost going to become like we're going to own the asset, we're going to own the contract, we're going to make 20% of all the profits that go on inside of the fund, and we're going to make income by being the paymaster, distributing all the income from the projects and financing and distributing that to the investors. So what would the market cap on a company be doing that in reality? We don't know. That's why we can part with this first 20%, because we believe that by having a dozen others over the next, however many years, we'll have a very rich asset. And of course, we'll have the benefit of now being more of a proven asset class. So it's very effective. I think it really does open up a new avenue for people that they don't generally get. And the idea of being inside an asset that's actually water, that's clean and green, does appeal to some people where traditional assets don't. So that's what I've been doing for the past couple of weeks.
Okay, so that was last week. Well, listen, that was so last week, last month rather. We have a whole new exciting situation. So this gives you the background. Now we're going to blow your minds. Meanwhile, there's another thing that's in the works. I told you about the crowdfunding that's been just launched. Well, you'll hear more about that. But also, we have some, Water on Demand Inc. is completing its full spinoff from OriginClear. And as a result, we're building a management structure while OriginClear continues to have a management contract to support Water on Demand with marketing, with finance, and so forth. The management structure is being put in place to ultimately make Water on Demand completely independent. So, what does that mean? Well, I'll tell you right now. We have a full-time COO, which is our good man James. You'll talk to him shortly. He'll be in the freewheeling discussion. We have extended an offer to a CEO. Can't say anything about that just yet. We're in discussions with a highly qualified deal CFO. And of course, I will continue to actively support both as chairman of Water on Demand, but also as CEO of OriginClear, which has that management contract to keep Water on Demand rolling. So this will complete the essential management structure of Water on Demand Inc. Wait for the announcement, or you will be able to learn more from Ken. If you're really nice to him, you might find out more. Okay, now, who is our VIP guest for June? Well, David Sillaman is the CEO and co-founder of OZExchange.com. You see, there's thousands of opportunity zones, but they're out there in the wilderness. This is kind of like the Coinbase of opportunity zones. Brings them all together. And now they can find each other and do deals. And you'll be hearing more about that in detail. He's on the Hill, because you may or may not know, but the Opportunity Zone Act is being updated right now in the big beautiful bill, and it's very hot and crazy going on right now in Washington. And he also works. He's associated with OpportunityZones.org, which is an important resource site, as well as Eazy OZ. And this is very important because you get instant compliance, and you could literally, create your own opportunity zone and put it into Eazy OZ, and that team would take care of you. We'll hear more about that as well. With that, drum roll.
David, thanks for joining. So we're gonna lean into the area that made my ears go up when you and I discussed it. Is there's an area of the Opportunity Zone exchange that it enables almost impossible to find entities to meet each other and meet opportunities, and the exchange makes that happen for the first time. It's almost like these were unknown businesses or unknown entities or unknown structures called closed funds. Yeah. So I'm gonna let you explain it, but to those of you in the audience and to those of you who see this subsequently in the YouTube channel, if you have any sort of substantial capital gain coming, I'm not giving tax advice, but if you have any sort of substantial capital gain out there, you could reach out to me, reach out to David. You should create, I think, after consulting your tax professional, an opportunity zone immediately. Not only is there a very high likelihood that this big beautiful bill will extend the deferral period for as much as 7 years, right? And look, why is 7 years good? Because you have other business ventures that are going to probably have offsets against that cap gain over the 7 years, which will be very, very beneficial. But whether if it's as small as $50,000 up to $50 million, by creating a closed fund, you get to enjoy a tax sheltered environment, and all the gains made in that fund for the next 10 years would also occur tax-free. So if you have a tax gain, you should probably reach out. You can reach out through me and our partner at David over at Eazy OZ and set up those funds. What David also does is, I don't know if it's in his job description, but he concierges these. David, you've already lined up a number of these closed funds for us to talk to, right? He's kind of so the day this thing goes live, boom, we're done. So we've been working on an offering with a select group of our kind of longtime investors. I expected it to go on for months and months and months, and enable them to enter and own the full sponsorship. It now looks that the minute we go live, we'll be exposed to that audience, and they'll invest in a far less generous structure, but it's still super good for them because they have the tax advantage, and that's through the OZ fund, through the QOZB. So sadly, I'll be cutting it short. So probably, I think we'll be live, by July 4th?
I would,
Probably, maybe. I'll talk with James on that tomorrow. But so by then, the world kind of changes for us, and we are now in the slot. And you've lined us up to talk to a bunch of smaller. They tend to be smaller closed funds. So why don't you start by explaining that process, and then a couple of things I want to cover. And you're an encyclopedia, so we could make this 4 hours, and I don't want to. But closed funds in particular, how that's unique, and how the exchange actually creates a marketplace for them for the first time. These basically wandering out in the wilderness. They've been sitting there for months and months and months. They're losing their tax advantage soon. They've not had any deal flow brought to them because no one knows they exist, right? And they don't know. They have to call the guy who set up the OZ for them, which may be their attorney, and he doesn't have any deal flow, right? So they meet one or two frogs that they get to kiss, and nothing turns into a prince. But beyond that, let's talk about you're spending time at the Hill with Senator Tim Scott.
Yeah, I've spoken with Senator Scott's office recently. Yeah.
Okay.
My time up on the Hill has been more on larger scale policy advocacy.
Okay, great. So we let's talk briefly on that. Let's talk about how the first stage of Water on Demand will be this closed fund type of experience, which allows us the time to basically set this whole thing up and then go to those open funds where we'll have systems on the ground and we'll be producing actual income for them, which is kind of our stage 2, which is how we intend to fill the larger $100 million fund. But give me your experience on it, and I'll just stop leading the witness.
No worries, Ken. And there's a lot to unpack there. Let's start with just the basic aspect of what a closed fund is first, why it's important, where it's at in the market space, and then the connectivity with it. All a closed fund really is just, it's a simple friends, family, Opportunity Zone fund where maybe me and you, Ken, maybe we had a business together, maybe we, flip properties, whatever the case may be. We realized some capital gains, and our CPA came to us and was like, hey guys, you should take advantage of the Opportunity Zone program. And he's, we followed his direction, and basically with his help, we were able to set up a very, very simple LLC company to act as a closed fund, reporting to the IRS using the Opportunity Zone reporting form 8996. So you and I, let's just say each of us had 5 million each. We've thrown into a closed fund. All right. What we've done is, and this is what's very unique, right, is we've stopped our own personal tax time clock because we put the money into the fund. But now what we've done is we've started a subsequent new time clock as a fund. And this is where a lot of closed funds get hemmed up, because now it's like, okay, we've set this thing up. We're a fund. We're on a very limited 180-day time clock, and we have to be able to begin to deploy that capital into a qualified Opportunity Zone business of some sort, right? So when we look at the Opportunity Zone ecosystem and we look at how much that's out there, there's tens of thousands of these closed funds all over the country, ranging from very small dollar amounts to very high dollar amounts. And it's the different side of the coin from an open fund like that's raising money. Okay. Now, the closed fund is going to be investing directly into WOD, the LLC company itself, as another member, no different than your open fund is going to be, right? So by launching WOD as a QOZB, in addition to launching the fund to support WOD as a QOZB, you're going to ride 2 horses at the same time. So it's like having 2 horses in a 2-horse race, right? Because you have your main fund, and then you also now have the business itself. Right. So now it's just being able to position the WOD LLC in front of the right closed fund audience. That's where the OZ exchange then comes into place. The idea is that the OZ exchange would act as that connection point for the closed funds that are utilizing the exchange to find deal flow, but also for compliance. And then WOD, the company, would be listed on the exchange, saying, as a business on there, saying, all right, we're an eligible Opportunity Zone business, and you can invest into us right through the exchange as a closed fund. Now that allows me, a closed fund, to be compliant. I've got access to WOD, deal flow, and can do this within this 180-day window. For WOD, a big advantage of this is that most closed funds, even though they have 180 days, the reality of it is, and like you mentioned it's the lack of deal flow.
Right.
And so what you're going to find
now what?
You got the now what, and you're going to find that a lot of these closed funds might be situationally in a position where they may only have 20, 30, 45 days left on a 180-day window. So it takes the due diligence time period, and it goes from something like this down to something like this in a lot of those types of cases.
So, all right. So there is a lot to unpack there. But what this does then is this exposes WOD in the very early, before we've completely rolled out, and we're working furiously with our incoming CFO. The incoming CEO is working with the incoming CFO and our present COO to get, I know James is working with you nonstop getting that set up. But really, the first thing, the minute this goes, let's say July 1st, July 4th, whatever, this goes live, you've got a slew of closed funds that may run the gamut from $50,000 to, 5 million, right? Yeah. They don't tend to run in the very large numbers, and that's probably, for the purposes of our conversation, probably better. But the idea is really you're gonna align a stable of suitors, if you will, to us, where we'll be able to, in a really comprehensive way, kind of get them under the hood, have them look at our project, and have them, with a narrowing time frame, probably be among the first deals they've had to look at since they enabled this fund. Now, a lot of these funds don't yet live on the QOZB. So what you're also going to on the QOZ exchange is, because a lot of these attorneys set these things up and kind of left these folks in a what now position. Yep. So you're doing a lot of outreach as well to let these orphaned closed funds, as well as the open funds, know that there's a place, that there's a lot of dynamic deal flow going on where you can showcase different investments to these players. And they have now, the first time in maybe a year since they set it up, an opportunity to look and start making some decisions. But yes, the due diligence cycle is shorter. So if it's compelling, if it's strong, the fact that it's nascent, the fact that it's extremely clean and green are very big factors in our favor. And the fact that the way it's shaping up will be highly competitive against other types of more mature asset classes that they already know they can go to. So the plan and the strategy that I thought, Dave, and I discussed that with you, is maybe say, look, you've got $15 million that you need to deploy. This is obviously a lot more upside as a business. It's not a real estate project. You can pretty much be assured to get your 5 or 8 or 10% or whatever. This has a cap gain upside that is, it's got the same competitive, play that we talked about, that 20% leveraged IRR, which is what we're targeting. But you're also getting shares in the company, or at least the LLC of the company. And, that's a $100 million fund now. That could end up being liquidated at a 10x because of how nascent we are. And that provides a second highly motivational aspect to investing in us, early on, that probably won't exist in the later stages. Do you agree?
I do.
Okay.
Absolutely.
Okay, great. I
think, and that's the thing about just being a QOZB, like a business-based QOZB in general, is, especially something like with WOD. The X factor upside, there's no ceiling to it, really.
Right.
Whereas with real estate, every deal is capped.
Yeah.
You're only going to get about so many square foot, so much per square foot, however you look at it, market conditions. But a business like this could be exponential in growth and value, being tax-free for me, an investor closed fund.
Right. So, unless an investor happened to buy, a piece of property that suddenly it was discovered they had rare earth minerals under it, right? Billions or trillions of dollars. That's the only, explosive, life-altering growth. Those are very reliable income plays that occur in a tax sheltered environment, which is great. If we can match that tax shelter or surpass it, which max that RIRR, or surpass it, which we're certainly confident we can do, but then provide that massive, really exciting upside and offer investors really a new way to invest tax sheltered money in something that, I mean, if you are in this, if you're into clean and green, we can argue that solar really isn't it. Oil and gas isn't it. Solar really isn't it. But making every drop of water you touch better absolutely fills that checks that box. So I think that's also very exciting. Tell me, you and I spent with Riggs about an hour. It was supposed to be a 5-minute conversation, but every time I talk to you, all of a sudden all this information comes out and I say, don't stop them, right? Because there's so much great stuff. But talk for a minute about, people have questions about, isn't QOZ going to end in, isn't the deferment going to end in December 2026? Speak to that a little bit. Speak to who you're collaborating with on that and where you get that knowledge, and then give us an idea of when you think big beautiful bill, which will perform these extensions, might be in place. Go ahead.
Okay, so I'll start with the latter part. The big beautiful bill, Trump has been very clear that he wants to sign it by or on July 4th. So, and I could see that happening. The Senate Finance Committee just did their reconciliation to the OZ side of this stuff in the big beautiful bill that has already passed the House side. What's unique is that the deferment date right now of 12/31/2026 that everybody's worried about, on the Senate side, they want to not only make the Opportunity Zone program permanent, but instead doing a rolling deferment date. That would be a 7-year window of time from the date you realize the gain. So that means that I could realize the gain, put it into the fund, and instead of being worried about paying tax on 12/31/2026, I'm now into 2033.
Right.
Point in time.
Right.
And with that, not only do I get the extra time period as it currently stands, but then I'm also going to get additional step-up tax incentives for doing the investment and holding it for a 7-year window of time.
Right. Let's talk about rural for a minute, because I went, and we're not going to talk about
one of them. Yeah.
The offsets, 7 years to find other offsets if you're running multiple ventures does make it easier to kind of soften the blow on a tax gain anyway. So 7 years is an adequate period of time. But then talk about rural, which I was very impressed by.
Yeah, there's a big push overall for two main things besides the permanency. One is going to be business, the other is rural, right? And on the rural side, they're offering a 30% step up to investors if the QOZB is doing its activities in a rural area. So if it's a rural-based business or a business location that is invested into as a QOZB from a QOF investor, I could get up to a 30% step up discount on my tax. So for someone that may not understand what that means, a simple math example is, let's just say I sold Bitcoin for $1 million. I owed tax on $1 million. A 30% step up means that in the future, after my deferment date, when I pay that tax that's due to Uncle Sam, instead of paying tax on $1 million, I'm only now going to pay tax on $700,000.
Right.
So
it's all the cap gains, of course, you pay tax on none of it.
And as long as I hit my 10-year anniversary date as an investor in the fund, then any growth on that million. So that, and there's no cap to the growth. That's the other thing. When we look at a company like WOD, I'm not, as an investor, I'm not being capped saying, okay, it's only going to be up to 5 million tax-free. Then I have to start. No, I could have a $25 million taxable tax-free event because of WOD as an investment.
Right. Elizabeth Warren's head is exploding right now, I'm sure.
Sure it is.
But so I had to say it, Riggs. I'm sorry. So one other thing, there was another feature, the bill or the structure regarding OZ that passed the House did allow for non-capital gain investment to occur. They have a cap at 10,000. So they were treating it mostly like a Roth IRA, a way to put in a little bit of money each year to escape taxes. But tell me about what you think the Senate's going to do, and if you can reveal why you feel so confident on that.
Well, the big push is to try to remove that cap. The Senate's reconciliation side had nothing in on the Senate side of stuff relating to that aspect of it, meaning non-capital gain dollars.
Right.
So now we're relying on, instead of a committee, now we're relying on the vote on the floor for it to get added in as a last minute add in to kind of massively unlock the OZ program. Yeah, it should be. All right. I can tell you that the original writers, crafters of the Opportunity Zone legislation, the intent for it was for it to be non-capital gain and capital gain dollars, both being held for 10 years to be able to get the benefits. It was clarified very early on through the IRS, through OMB, that no, it's just capital gain dollars. But the original crafters, which was Senator Tim Scott's office, right? So the original crafters of that, and since he's leading the finance committee and he's leading the charge on Opportunity Zones on the Senate side, him and Cory Booker, it's a bipartisan supported initiative. We're very, very hopeful that we'll see that finally added in, and that would pretty much unlock for any type of money to be able to be invested into the OZ space.
So for flavor, there's an estimated $9.6 trillion of cap gains that are going to occur in the United States this year that could potentially be eligible to enter a QOZ to defer and then earn on in a tax-free environment. Think about the amount of capital required to create a $9.6 trillion cap gain, right? Yeah. Most of those cap gains are not 10, 20, 30x, right? You didn't start out with $1 trillion and created a 9.6. Those were, in some cases fairly modest, right? So we could
runs the gamut from everything, like from stocks to cryptos to real estate to selling businesses to, it's the whole national,
that's the whole national gross domestic product in a way, right? But you could be, if there's a $9.6 trillion cap gain, it could have been 20, 30, 40 trillion dollars that was required to create that sort of a cap gain. Yeah. That capital would now be open to investing in a QOZ, which completely changes the game. Right. Now it may change the dynamic somewhat, and there'll be other things to contend with, but that is one of the most thrilling aspects of this. So we're looking at around July 4th, the big beautiful bill may remove cap gains as a gating feature. Right. It's also the time, incidentally, that our fund will be up and running. You've already corralled a few of these closed funds for me to begin to speak to. So the minute this goes live. So the benefit to us as a company is what we've done is I shared with you our strategy. We've allowed our investors to participate in the sponsorship of the first fund, the first $20 million worth of ownership. And the goal was, or the original plan was, because I didn't know this existed, right? I said, well, here's what I'm going to do. I'm gonna share, essentially all of the income on the whole 20 million, and that'll give me time to, get our systems in place, start creating income, so then we can begin to go to those larger institutional grade investors that are in the fund, that are shopping different deals, and we'll be able to start to kind of crack that ice a little bit. And you were like, yeah, but what about closed funds? And I was like, well, tell me about that. And it kind of changed the game. I went, okay, never mind. Right. So the minute that this goes live, we'll be able to immediately appeal to them. And like I said, the reduced due diligence, and they're much closer. They're kind of a bridge between that institutional investor, which is a different animal, and the our individual accredited investors who we primarily deal with today. They're somewhere in between, a little bit closer to the accredited investor. And what I wanted to share with my audience is what I was incredibly grateful for is not only are you lining up these conversations, but you've been this incredible concierge where you're actually going to work directly with us to produce a way to present these to both the smaller and larger funds that your vast experience already demonstrates is highly successful. So there's so many different layers of it. So I want to say I was right, and I was only right meaning that it validated wanting to partner with you guys, because the value in just getting the exchange set up was 1% of it. So we're very, very grateful to have your partnership in this, and thank you.
I'm honored. Thank you.
Thank you. So Riggs, you want to chime in?
Absolutely. Well, that was really interesting because I think it was revolutionary that what always bothered me was that we were all of a sudden going to have to go to a
Right.
$25 million investor, right?
Right.
From
Right.
our current level of investor. Well, this
Right.
literally, we can bring in these dedicated funds, these closed funds, which are single purpose, smaller amounts, and they are a lot like our own investors. In fact, I'm thinking I better start an opportunity zone for, my family as well.
Right.
So everyone can
Closed
and should
funds.
do it. But this gives us access to an audience and it allows us to speed up our plan and to rely less on selling that precious general partnership.
I'm going to give you one
Excellent.
more thing that it does as well. It removes the accreditation, non-accreditation barrier because the fund's a company, not a person.
Oh,
So
that's
now you
really
don't have to
interesting.
worry about are they accredited, non-accredited, or any of that kind of stuff.
Wow.
It's an Opportunity Zone fund. It's usually
See,
an
this is
LLC.
more breaking news, right? That's why I said
Well, they're
just let
likely
him
to be
go.
accredited. I mean,
Rick, right.
it'd be an edge case if they were not accredited, but we don't have to worry about that,
Sure.
which is
Right.
wonderful.
In other words, right, the AML and KYC is a little bit different. There was something. Now you just broke some more news there, so I forgot what I was going to ask you, and it was actually really really good. But it escapes me at the moment. So
Well, here's what I think we should do, because we can keep talking. I would like to introduce the rest of the gang,
sure.
because James has been working hard with David, and I'd like him to report on what he's been doing with David, and the operational side, the logistics, and of course AJ as he's madly doing back switching in background. So let's bring in the freewheeling discussion.
No, I've been working with David over the last week or so, coming on board on the platform. Um, I mean, I got to say, this is talk about someone holding your hand every single step of the way. It's been an absolute pleasure. We're rocking and rolling is the only way I can say it. It's our entity is already registered. We've already got an LLC up and running. In fact, I mean, there's multiple steps in the process, but as I say, it's David and I are now texting buddies. We
Oh yeah,
communicate we communicate
just
a
about
lot.
daily.
It's
Yeah.
it's it's literally daily, and I'm like, just give me a one-word answer, yes or no, simple as that. And I get the responses quickly. Ken, you and I'll have a mind meld tomorrow morning, but no, we're on
Right.
track. All is
Right. No, and that's excellent. So the timing of this setup and you know, he's David has been almost like he's setting up these presentations to this whole group. And now you said, David, what was it, 10,000 or tens of thousands of closed
Yeah,
funds
well,
already?
it's a very difficult number because
Right. You don't even know
the
it.
IRS doesn't release it. Like
Right.
they don't say that there's X number, although the reporting requirements for all this stuff is going to be a lot more open here very soon after the big beautiful bill and stuff, because there's going to be some enhanced reporting and more transparency, so the community knows more. But when you think about how much, just how many people that there are that have capital gains, how many people that work with CPAs, there's so many of these little friends and family funds all over the place that,
Hmm.
and since they don't follow the same protocols as an open fund, which is typically, two main states. You can usually, do Form D searches with the SEC. You don't have any of that
Right.
to find a closed fund. And as much of that as the problem for like a business, it's also the exact same problem for a fund trying to find a business.
Sure, sure. Right. It's that anonymity
Hmm.
that becomes a barrier to them staying in compliance and finding an appropriate investment. So the clock is running down. So there are thousands that are now down to weeks and months, not a
Absolutely.
year, a year. And there are thousands of them that are down in weeks and months. And the
Hmm.
idea is to essentially get us in front of those right away. Which look, I have been a great supporter of this concept. I always knew that the tax feature was the thing we needed to make an asset class. Because having these conversations, they're like, "Great, what's the tax break?" And you go, "Oh, I don't have one." They're like, "Okay, we'll come back when you do." So this was a panacea for me. But I've always, the original plan was to create this space to give us the time to begin to go from the individual accredited investor, probably run a separate PPM doing what we're doing right now, which is very successful, but it's a grind, right? It's it's a lot of work. And then kind of bridge the gap to the point where we've put systems in place because James is killing it and we're getting stuff done and our incoming CFO has modeled it right. And then be able to go to not the $25 million fund maybe, but a $5 million fund and say, look, we would like you to do, 10%, 20% of your fund in this and stick with what you know. We thought that was the kind of the general glide path into this. The ability to put away millions in the first couple of months with an offering that doesn't, we're not, look, we don't mind parting with the 20% of the income on the first $100 million because we plan on having 20 of these things, God willing. But to not have to, so now instead of just giving it to our investors, they'll be partnering with us. They'll own it alongside of us. Those have already participated, and the last few that are going to get involved before we get done. So that actually allows me, and this is a concentration issue for me, right? This allows me to now pivot and focus entirely on presenting this to that specific audience with your tutelage, with that tapping into your experience in how these are generally successfully presented, along with having you get under the hood in the offering and how we're able to do it. So that, to me, that's really exciting, and I can't wait to get started.
Great story, actually. When I was checking references on David, I spoke to a person who had created a very large fund, and the poor guy he'd just come back from pitching Comerica, the bank. Right. Well, this was the biggest problem we looked at. It's like, we're going to have to start pitching banks and people like that. Well, maybe eventually, but let's build, a ramp. Let's ramp up to it. And right. What I want to say right now, that I'm super grateful to those of you who have stepped up so far to help fund this process, because by stepping in to become part of the general partnership, you're making it possible for this fund to launch, and it will be huge. This will be a vast endeavor, and all of these small funds, they're going to come in flocking because it's a quick answer. It's incredibly needed. They'll know it's good, and we will have a really excellent offering. But more importantly, their demand requirements won't be the same as Comerica, right?
Right.
The demand requirements will be
major difference. Right?
I think it's good. Let's do it. Okay. So right. I'm really excited about that, and I think it's going to. I know. We just learned that we're going to turbocharge and accelerate this whole thing. So
those of you who have participated in that, thank you. You're about to be richly rewarded, I suspect, as a result of this new transition. And I was perfectly happy to just do the whole 20%. But now that I don't have to, that's good too. It's not just you guys will partner with us. You'll own your pro rata piece, which is great. But getting that early income as a business and as a company, and what it does for our company stock, is also very, very good. And it allows for me, like I said, I think the biggest value to me, Riggs, honestly, is focus, right? Just basically now your next audience is what I'll, develop working on.
We have a few minutes left, and I really wanted to check in with James on the other side of this, which is going and finding the deals, right? Because raising the money is one thing, but without projects to do them on, that's another. And so you're working with, of course, Dan Early, who has channels out. I think you're working with our partner Envirogen, who is officially a partner of ours. So tell us a little bit about where you're at with the scouting of these new potential clients.
Yeah, thanks, Riggs. Yeah, I mean, look, that's what keeps me up at night at the moment. Truth. I look at it as a left-hand side and right-hand side. The left-hand side, which is getting the fund up and running, it's pretty straightforward. A lot of work, a lot of heavy lifting, but we've got David and I've got people like Ken and you, et cetera, et cetera. Like, we know what we need to do, but we just got to go through the steps. It's the deal discovery that I'm really thinking a lot about, which is, Riggs, to your point, how do we go? We've got the money, now where are the deals? And yeah, no, I'm spending a lot of time with it's the enviro maintenance, it's the Envirogens, there's a lot of people that are literally just popping up out of the woodwork because they hear we've got money and they got deals. Some of them are good matches, some of them are not. Ken, to your analogy of kissing frogs, I've been kissing a few frogs lately. But I'm essentially working on building up a stable of partners, is probably the right word. People out there that are building these systems, they have their own networks. And really what it comes down to is when there's a need for cash, when there's a need for capital, when people don't know how they're going to fund their business, that's where we can fit in my simple way of understanding it. I had a conversation yesterday with another one of our partners that we work with, a company called Clear. And they work on massive projects. We're talking governmental, municipal, $100 million type projects. There may be some places for us to work together, but just going through that conversation with their head of customer success, I got a whole bunch of other breadcrumbs to now go and chase down. And she's like, well, have you thought about this? Have you? And we pull up the AI and I'm like, give me those prompts. I need those prompts, So yeah, no, look, it's not easy, let's be honest. But I know what I need to do. And really what it is, as I say, there's the left-hand side, which is build the fund, but the right-hand side, what's really got my attention is, and then David, having spoken to you and listening to the conversation you and Ken have had, which is that clock starts ticking. Okay, I've got to find those deals, and I've got to find those deals now. So that's in a nutshell where that is.
When we in an earlier iteration of this process, some feelers were put out, and they said, look, in a perfect world, if I brought the money to fund your project, what would you have? And there were $20 million deals being thrown, right? And this is before the capital was ready. So there's a pent-up demand that's enormous. But you're right. It's the Goldilocks thing at first, James. In other words, not too hot, not too cold,
exactly.
Not too large, not too small. It's going to be more of a finding the just right Goldilocks one. But we want this to go from satisfying kind of that immediate, urgent, in some cases, desperate business need, that business person's need or that businesses need, to slowly transitioning as we fill more and more of these funds and to being just how this business is done.
Yeah.
In other words, people don't buy homes for cash as a general rule. There's real estate financing. It became how things were done. Now, what happened as financing became available, real estate became more expensive. It's just like when you pay for college tuition, all of a sudden college tuition rises. So it actually will, I think, open up margins for these businesses. The margins are very, very tight. When money becomes easier to obtain, or when access just to the technology and being able to put it in place becomes easier to do, I believe that the folks that are, building, manufacturing, selling, kind of grinding away at these things, they'll be able to make a lot more money. That starts to change the paradigm, and then all of a sudden the companies chase the money.
But the important part is
right now you're chasing the business will chase the money eventually.
The important thing is to recognize that there's demand right now. We spoke to a company last week that said, we have businesses coming to us all month long, all the time, that say, hey, can you finance my water system? And they can't really do it because, again, it's access to capital. So by us being the solution, it's going to blow up. And as Ken says, it'll be like when Ford first introduced finance payments for Model Ts, it blew up. And that's really what we're talking about here. So I think that this is the best news I've heard yet. Thank you all, our investors listening now, for really having contributed to this. We're now going to go into full high speed with a full management team. Now, we have a bonus. And before I show that bonus, I just wanted to, if AJ is willing, he can show the contact screen. If you're able to, quickly show the contact screen to talk to Ken to get some more of the skinny. And then, whenever you're ready, AJ, I want you to go ahead and show this amazing tweet that Ken just put out.
Okay.
It's so freaking exciting, and it's blowing up.
Yeah, let me talk about this for a minute. So, at the end of the tweet, essentially what it talks about, Trump went to a model. So he went through a bankruptcy, had to renegotiate, Taj Mahal, all the casinos. He was $990 million underwater. He talked to Marlon Maples one day on New York. There was a guy panhandling. He says, that guy's got $990 million more than me. Right. That was his, he was actually fairly humble about it, fairly realistic, but he reinvented the personal brand. So what he did was he changed his entire dynamic. He began to lease his name out, get $1.5 million to put my name on a building. Right now, you can't, if you don't pay the mortgage and they can't repossess my name. Right. So essentially it came down to, kind of getting out of the building and structures end of the business. It became personal brand. And in a nutshell, he lost ownership, but he kept getting paid to run the property. So the banks realized that they bought expensive real estate, right? So what he did was he was bankrupt. He turned personal publicity into currency. He appeared casino openings. He basically rented himself out. And I remember going to a number of money events where Donald Trump did like a 10-minute speech, and I heard he got paid, come see me and what they're paying me $1 million to tell you. I remember those back when I was a kid. Sure. But long story short, he launched The Apprentice. He made $427 million in revenue. He wrote off every dime of income that he made for 18 years. Everything he made, because he had that one-time write-down. So all of his income in the past 18, remember they were attacking him, he's lost money. He says, yeah, I've been writing it off for 18 years. But so he said, stop. So the bottom of the tweets is, look, stop owning, start licensing. Buildings, don't buy buildings, license your name. Don't, just collect royalties. Don't risk capital, monetize reputation. There are two businesses out there competing to put a $12 or $15 million water system in place. Who's better? The buyer's going to have to figure it out. The sellers are going to have to basically beat the hell out of each other to figure out who wins the deal. I don't care. I'm financing both of you. I'm making the capital available to either one of you. We go from pipe bending, we go to true velocity of capital and true banking. And in every single case, the realtor doesn't care. Well, the mortgage guy doesn't care who buys the house. Maybe the realtor does, because one realtor wins, one realtor loses. But the mortgage guy, and I was in the mortgage business, I didn't care who bought him. Right? Now, taking it one step further. I asked the mortgage guy when I first started Water on Demand with Riggs, I said, you're in the mortgage business. How many loans would you do if your borrower had 450 credit and you could do it? He goes, all of them. Now, we're not there yet, but there's going to be derivative products created from this where we're going to be able to start financing en masse.
Well, remember, water as a service does not depend on good credit because we can repossess.
Yes.
It's a rent-to-center model. So actually, this is a huge breakthrough. What you just said about that mortgage broker, we can deliver to anybody who has a water problem. And that's really, really exciting. David, I really want to thank you for being here today. It's been wonderful having you. We're so happy we're on board. We strongly recommend that you go to David. And if Ken is not available to refer people to David, James will be happy to do so. But go ahead and just send it.
Apparently they talk every 5 minutes, so that works out.
Well, okay. It's a good thing that David doesn't have a meter going.
No, I've had a blast. It's been an honor being here. So thank you for bringing me on to the I guess the monthly meeting.
Exactly.
And you're gonna probably have some updates for us fairly soon. We might have you back in about a month, right?
Yeah, we should have the final bill signed, which will give us the final, where's OZ 2.0 going to be at.
All right. And by then our fund will be up and running, and we might have some breaking news. We're going to have some other breaking news on management and other things like that. So we'll keep you informed. David, expect a call tomorrow. I do have something I wanted to ask.
Oh my God.
You did return my call, but we'll get that tomorrow.
Okay.
I tried calling you 3 times today.
I know you did.
Uh-huh.
Okay.
That's really good that Ken was hard to get to. I like that.
Mhm.
He's a busy guy.
I'm
Ken
sorry.
is
I'm sorry.
No, it's
locked
okay.
up. But anyway, but I won't be his receptionist, so you'll just have to fight for it.
David took it better than my wife.
Oh my God. Yes, well, I have the bypass too. If I see that call, I go, sorry, got to talk. But just if you're interested in doing your own Opportunity Zone, you can get to David through James at waterondemand.net. He'll be happy to connect you up. Of course, Ken will, and Ken is going to give you a lot of the skinny about what's going on the management team and
Yeah.
everything.
Yeah,
So-
but and the other thing is that we expect this thing to be up around July 1st. So unfortunately, the ownership and the sponsorship is going to and we're going to probably wrap that up next week.
And remember, he's hard to get to these days, so watch out. All right. Thank you all. It was a pleasure. Remember, it's the third Thursday of each month. And next month, it is going to be the 17th, Thursday, the 17th of July.
And
Be
have
there.
a happy 4th of July before then.
Enjoy the 4th, everyone. Thank you all.
Bye-bye now.
Have a good night.